Hello, Gary Mrozinski here, and we are going to be talking about fiscal policy in this video. The content for this presentation is taken from the Macroeconomy Today by Schiller and Gebhardt, published by McGraw-Hill. Fiscal policy is when the government makes a change to its fiscal plan in order to influence the economy. And why might they need to do that? Well, John Maynard Keynes told us that the market system economy, as flexible as it is often not stable. And it goes through business cycles. It goes through swings, increases in output, decreases in output. Sometimes you want to smooth off those decreases in output or even increases in output if it's causing inflation. And you do this by acting on the aggregate demand curve, trying to increase spending in the economy or decrease spending in the economy through your fiscal plan, changes to your fiscal plan. When you're doing this, this is fiscal policy. This is what we will talk about in this chapter, exactly how that works. In this chapter, we'll talk about how government spending and taxing, changes to government spending and taxes, can influence the economy. Remember that the government's fiscal plan has on one side its plan to raise revenue, income, and that is taxes, so its tax plan, and on the other side, its expenditures plan, its budget for spending the money. And the government comes into the year with a plan that hopefully is balanced. It might be the middle of the year and maybe there's a need for fiscal stimulus. Now they're going to make a change to that plan in order to stimulate the economy. So how might they do that? Well, they have two choices, right? They can either decrease taxes, which increases income, disposable income for consumers who then spend it. That's one way to do it. Or they can spend more money themselves, increase government spending, which becomes an increase in income for any companies that the government's spending that money on. They have marginal income, right? So those are the two options, and we'll talk about exactly how that works. There's a third option. They can increase income transfers, which means increase, for example, unemployment benefits, unemployment payments. Now, this happened with the recent pandemic when the government added an extra $600 to people who were eligible to collect unemployment benefits. And they also expanded the pool of people that qualified for unemployment benefits to include people that own sole proprietorships, small businesses. And so this was increasing income transfers. That is a third option for stimulating the economy. When the government does either one of these things, lowering taxes or increasing government spending, that shifts the aggregate demand curve to the right. Sometimes they want to do the opposite, decrease spending in the economy. We haven't seen that in a long, long time, but it could be possible. Well, they're going to then want to either raise taxes, which decreases disposable income and decreases consumption, or decrease their own government spending, cut from the budget funds available to the various departments of the federal government. If the problem in the economy is that the economy is not producing enough and you have high unemployment, it's a recession in other words, then fiscal stimulus would be called for. And we're going to start with that situation. If the problem in the economy is that you have high inflation, and this typically happens when you get to the point where unemployment rate is below full unemployment rate, below 4%, and you hit the inflationary flashpoint, which we talked about, then that could drive up prices and cause inflation. So in this case, you want to decrease spending in the economy. This is fiscal restraint. We'll start with fiscal stimulus, and then we'll go to fiscal restraint. Now, I'd like you to get used to this graph and the way it's labeled. Whenever you see Q sub F, remember that's full employment level of output. That is the amount of GDP you would be producing if you were at the full employment unemployment rate, which let's say is 4%. Q sub E, whenever you see that labeled on a graph, that is the equilibrium output. That's the GDP you are actually producing at this point in time. Okay, so if you see this graph, and I'll have to tell you that only pay attention right now to the demand curve that's labeled AD1, the one further left. Okay, try to ignore the other two. You're only looking at AD1, and of course you can see the aggregate supply curve. So point A is the equilibrium point, right? That's the intersection of these two. Prices are at price index level P sub E, and then the output of this economy is $5.6 trillion. Okay, that is the equilibrium level of output, meaning it's what you're producing currently. Now you can see that Q sub F on the x-axis is to the right. It's a larger number. So you are producing less than the full employment level of output. That means you have unemployment that's higher than 4%. That means you have a recession. Now you can see recessionary gap. What that means is recessionary GDP gap means that you are not producing enough GDP and you want to close the recessionary GDP gap. You want for the economy to be producing, and you can do the math here, right? $0.4 trillion more, so that's $400 billion more. Now the question is, how do you do this? Well, fiscal stimulus will do this. Fiscal stimulus will move the aggregate demand curve to the right. Now the second question is, how much additional spending do you need to close the recessionary GDP gap? The answer is not 0.4 trillion or 400 billion. Remember that dollars are on the x-axis, so you need to move horizontally. That's how you measure dollars. So horizontally, how far does the demand curve need to shift so that the new intersection point is above the full employment level of output, which is 6 trillion. You want for the new intersection to be vertically right above 6 trillion. So follow that dashed line from 6 trillion vertically, and you can see you want the new intersection point to be at point D. Now to get to point D, you need to move horizontally more than 0.4 trillion. If you move only 0.4 trillion, you actually end up at point C. I hope you can see geometrically why this is the case. Look at the dashed line that's going horizontally from P sub B across the graph. That's showing you the horizontal distance the demand curve could be shifting. You want to go all the way from point A to point E, shift that horizontal distance. So what distance is that? And when you're evaluating these graphs that are given to you in these problems, you could not tell from the slopes of these curves what the horizontal distance would be unless it were labeled on the x-axis for you, and it is here, right? So you can see you need to travel a total distance of 6.4 minus 5.6. That's the horizontal distance. It would be a distance of from points A to E. If you do that, if the demand curve shifts that far horizontally, the new intersection is at point D, which puts you above the full employment level of output. Now, the horizontal distance that you want the demand curve to shift is known as the aggregate demand shortfall. That is the amount of new spending you need to create in the economy through your fiscal stimulus and then the multiplier effect that happens after you stimulate to get you to the new equilibrium point, which would be above the full employment level of output. Okay, so again, to summarize, the aggregate demand shortfall is the amount of new spending you need to cause in the economy to shift the demand curve to the right far enough horizontally so that the new intersection point, which will become your new equilibrium point, has closed the recessionary gap. So the recessionary gap is the amount of new GDP that will be produced. The aggregate demand shortfall is the amount of new spending you need to cause to close that recessionary gap. So it will always be larger than the recessionary gap. because prices adjust upwards to take away some of those dollars. And in this slide, we're just, again, defining that the aggregate demand shortfall is the horizontal distance, which is measured in dollars, which is the amount of new spending you need to cause to get to the new equilibrium point, which would be full employment level of output. So here is, in the box on the bottom of this slide, a reminder that to shift the aggregate demand curve to the right, that represents some total amount of new spending. The government doesn't need to do all that spending themselves. They just need to do a fraction of it. They need to stimulate the economy, and then because of the multiplier effect, there's extra levels of consumption, rounds of consumption that add up to the total amount of shift. So we know what the multiplier is, right? If you know the multiplier, then you multiply the fiscal stimulus by the multiplier. That gives you the total amount of new spending that would happen in the economy when stimulus occurs. That you want for that to be the aggregate demand shortfall. That amount of horizontal shift should equal the aggregate demand shortfall. You set that as your target. Now you normally know what the aggregate demand shortfall is, and then you're working backwards. You're trying to figure out, to accomplish that total amount of new spending in the economy, what stimulus do I need? If you're the government, you're going to start with some smaller amount of stimulus, and then it gets multiplied. Well, you do it this way. You divide the total amount of new spending you want to cause, the aggregate demand shortfall, by the multiplier. So if the multiplier is 4, then you divide the aggregate demand shortfall by 4. That is how much initial stimulus you need to cause. Now maybe instead of stimulating the economy by increasing government spending by some initial amount, instead you decide to do it by lowering taxes, by doing a tax cut. That could accomplish the same thing, because when you lower taxes, that creates more disposable income for consumers who then spend it on consumption. So that's the big C part of the GDP equation, right? So you need to lower taxes to cause an increase in consumption spending. Now you can do that by lowering taxes on individuals. So again, that will increase big C. Or you can lower the corporate tax rate, which is something that we did in 2018. This causes corporations, businesses, to spend more. And a lot of that spending would happen in gross investment. So the GDP equation, remember, is G plus I plus G plus net exports. This would be the I. This is businesses spending on new capital, purchasing new equipment, replacing older equipment, new computers maybe, renovating their facilities or building new facilities. This is big I, capital goods, spending on investment. Corporate tax cut should cause I to increase. And that also stimulates the economy. That makes the aggregate demand curve shift to the right, because that's part of aggregate demand as well. Now let's say the government is going to use a tax cut to stimulate the economy. There is an extra step that needs to be accounted for. Let's say that fiscal policy calls for an initial round of spending, initial stimulus of $50 billion. And then that will get multiplied to give us the rest of the increase in spending. So if they did this through government spending, they simply would increase government spending by $50 billion. And then that would touch off successive rounds of spending and get us to where we need to go. If you're doing this through a tax cut, it's not enough to lower taxes by a total of $50 billion, because, remember, there is a marginal propensity to consume, let's say it's 0.8, that tells us that when people receive this marginal income, they're going to save some of it. And if the marginal propensity to consume is 0.8, that means they're only going to spend 4/5 of the marginal income they receive through this tax cut. So if there's a tax cut of $50 billion, then only $40 billion will be spent in consumer markets. So you need to sort of back into the amount of the tax cut, which is going to be some larger amount than the initial stimulus that the economy needs. So if $50 billion in initial stimulus is needed, what size does the tax cut need to be? Do you see the equation, the top equation in the box there? You need to solve that for tax cut. To do that, you'd get tax cut equals initial increase in consumption, which we want to be $50 billion, divided by a marginal propensity to consume. You see that? Tax cut equals initial increase in consumption divided by MPC. So if we want for the initial increase in consumption to be $50 billion, then we need to divide that by 0.8. That makes it a larger number, right? 50 billion divided by 0.8 gives you 62.5 billion. So you need to implement a $62.5 billion tax cut in the economy so that people then will spend 80% of that, $50 billion. They'll save 25% of 62.5, which is $12.5 billion. And then you just need to remember to do that step if you're going to stimulate the economy through a tax cut. Now let's look at the second equation in the box. If the initial stimulus, the initial change in consumption spending was $50 billion, which was caused by your $62.5 billion tax cut, how much total change in spending would there be? This would be to correct the aggregate demand shortfall. Well, it would be 5 times that, right? The marginal propensity to consume is 0.8, which makes the multiplier 5. So it would be 5 times $50 billion, or $250 billion. So the way you solve these problems is you start with figuring out what's the total amount of change in spending you need. What's the aggregate demand shortfall? Then you back into the stimulus that's needed. What's the initial change in consumption that's needed? Then you, from there, back into what's the size of the tax cut that is needed. And we'll be doing examples of this. And these two bullets are making the point that whatever the size of the tax cut is, that's not all new spending. Some of that is going to be saved. And so the size of the tax cut needs to be larger than the initial increase in consumption spending that you're looking for, the initial stimulus. So you start with some desired fiscal stimulus, and then you make that larger to account for the fact that some of the tax cut is going to be saved by the people. Now, if you're going to stimulate the economy by increasing public transfer payments through some sort of maybe one-time transfer, this is what was done initially with the pandemic, the very first CARES Act, right? There was an increase in transfers. Unemployment payments increased by a special extra payment of $600. And so that works like a tax cut. What I mean is, you need to account for the fact that some of that $600 that changed to marginal income, some of that is going to be saved, some of that is going to be spent. Now there's something called the balanced budget multiplier. This is a tricky concept. If you don't get all of this, don't panic. You're still going to do fine in Chapter 11. But this is one of the finer points of the chapter. Sometimes there's a decrease, or sometimes there is a disagreement among those that are putting together the stimulus package in whether we should stimulate the economy by lowering taxes or by increasing government spending. And so sometimes, as a compromise, the people that oppose increasing government spending will say, we will agree to it as long as whatever the increase in government spending will be, it is balanced by an increase in taxes of the same amount. In other words, we're going to increase taxes on people by the same amount that we increase government spending. Then we don't create an imbalance in our fiscal plan, right? Whenever you do fiscal stimulus, and it might be in the middle of the year, you're creating a larger deficit. You're either increasing spending without increasing revenues or decreasing revenues without decreasing spending. So this is saying, as an alternative to doing that, let's increase government spending but then increase taxes by the same amount. So what would be the net effect is the question. Well, let's think about this. Let's use the same numbers we were using previously. Let's say that $50 billion in initial stimulus is what you think you need. If you do that through increased government spending by 50 billion, then you're going to increase taxes by that same amount, right? If you increase taxes, that decreases consumption spending by some amount. By what amount, though? Well, again, let's use the same numbers. Let's use a marginal propensity to consume of 0.8. If you increase taxes by $40 billion, that will decrease consumption spending by 4/5 of that, right? 8/10 of that, or $40 billion. So you have government spending going up by 50 billion. You have consumption spending then going down by 40 billion. So there's a net increase of spending in the economy of 10 billion. That 10 billion gets multiplied by the multiplier. What was the multiplier? Marginal propensity to consume was 0.8, so the multiplier was 5. So that $10 billion of increased spending gets multiplied 5 and becomes $50 billion. The balanced budget multiplier is 1. In other words, there's no multiplier. So to summarize, if you decide to stimulate the economy by increasing government spending, and those that oppose this insist on increasing taxes by the same amount so that the tax increase pays for the increase in government spending, thus not affecting your budget, then there will be no multiplier effect. If you increase government spending by $50 billion and lower taxes by $50 billion, the other way around, increase taxes by $50 billion to pay for it, then consumption spending decreases by $40 billion, so there's only a net increase in spending in the economy of $10 billion. That $10 billion gets multiplied by the multiplier, which is 5, and becomes $50 billion, and so there's no multiplier effect. And again, if you're not following all this, this is not the most important concept in the chapter. It's one of the finer points, and you'll probably be fine, but you might want to play this back 1 or 2 times to kind of grasp the whole thing. Now, fiscal restraint might be called for if the aggregate demand curve were as indicated by AD sub 1. In other words, the equilibrium point is at capital E sub 1 on the graph. Now, see, the issue here is, look at how the aggregate supply curve curves upwards and becomes more and more steep in that region of the aggregate supply curve. That's because we are approaching the maximum capacity of the economy's ability to produce. So there is some theoretical upper limit to the GDP that our economy can produce because we have limited resources. We have a limited number of workers, for example, and once they're all working, we can't produce more GDP. And so the aggregate supply curve curves upwards like that because if there were to be an increase in aggregate demand, it would have to lead to rapidly rising prices because producers can't produce anymore because they're already employing all the workers and they can't find more workers to try to expand. So for that reason, if the aggregate demand curve is positioned as it looks there in AD1, steeply on the steeply rising part of the aggregate supply curve, that means that the price index, as you can see, is high. Prices are rising. This is inflation. The problem is inflation. Remember we talked about the inflationary flashpoint. If you get too far below 4% unemployment rate, if that's considered the full unemployment rate, Then it's going to lead to inflation because everyone's already working, and if there's increased demand, which shifts the aggregate demand curve to the right, there's no other resources to employ to produce more, so it's going to lead to high inflation. So suppose this is happening. So again, you're at point E1 on the curve, and that's the intersection between the aggregate supply curve and the aggregate demand 1 curve. All right, now go down to the x-axis. Where is full employment level of output? 6 trillion, right? And we are producing 6.2 trillion. We're actually producing more than the full employment level of output, the full employment GDP. Which sounds good, except we have inflation. This is where fiscal restraint is called for. So the government would act on that aggregate demand curve to shift it to the left by some amount. How much does it need to decrease? Well, we know GDP needs to go down by 0.2 trillion in this example, right? Looking at the x-axis. That is the amount of the inflationary GDP gap. So we need to decrease spending in this economy. The total amount of decreased spending that we need to cause is the aggregate demand excess. There is an excess of aggregate demand that we need to remove. We need to remove some spending. Now this works the same way as it worked with fiscal stimulus. You need to think horizontally. How much do you need for that aggregate demand curve to travel horizontally to the left so that you end up at a new equilibrium point, which is E sub 2, which vertically is right above Q sub F. Q sub F is always your goal, right? You want to get back to the full employment level of output. Well, how far to the left horizontally does it need to travel? Not 0.2 trillion, but 0.4. And again, thinking horizontally, you need to move from point E sub 1 to point F because prices are going to fall. And that was the goal in the beginning anyway. All right, so horizontally, and you can follow that down to the x-axis, and you can see that the difference between 6.2 and 5.8 is the aggregate demand excess. That's the total amount of decreased spending that you want to happen in the economy to get you to an equilibrium point that produces $6 trillion. Now remember, the government doesn't need to account for all of that themselves. They just need to, it's like reverse, it's the opposite of fiscal stimulus. They need to decrease spending by some small amount in the beginning, which then will multiply in the economy and lead to successive rounds of decreased spending. This is the way fiscal restraint works. It's the multiplier process. So again, aggregate demand excess is the horizontal distance you need that aggregate demand curve to travel. That's the total amount of decreased spending you need to cause. Remember, dollars are in the x-axis. They don't move diagonally. They move in the x-axis. So how much decreased spending do you need to shift that aggregate demand curve? Well, again, you would need for the x-axis to be labeled as it is with numbers that you can read. Now, you wouldn't be able to figure this out by looking at the slopes of the lines. So, very handily it is labeled for us, and it looks like the difference is 6.2 minus 5.8, and this is in trillions. So that would be 0.4 trillion or 400 billion. The aggregate demand is 400 billion. We need to cause some total amount of decreased spending in the economy of 400 billion. So there's some amount of initial decreased spending, the desired fiscal restraint, that is needed to correct the total aggregate demand excess. Well, it depends on what your multiplier is, right? If the marginal propensity to consume is 0.75, then you divide the aggregate demand excess by 4. And that's the amount of initial decreased spending that you're going to fiscally cause, which then gets multiplied by 4. You can do that by either decreasing government spending or by raising taxes. If you're going to do it by decreasing government spending, then you remember you multiply that by 4 to get the total amount of decreased spending that would occur in the economy. And you're working backwards, really. You start by knowing the horizontal shift you're looking for. That's the aggregate demand excess. And divide that by 4 to get fiscal restraint. That's how much you need to decrease government spending by. And you could do this by decreasing spending in any of the major divisions of the government. Now it's mentioned here, decrease military spending. You don't usually use the military's budget to stimulate the economy or restrain the economy. You adjust the size of your military based on need. Like I said, you don't increase military spending to stimulate the economy. You increase military spending when you feel threatened, especially when you're engaging in war. But that will have the effect of stimulating the economy. But you could increase or decrease infrastructure spending, spending on education, spending on energy, spending on any of the major divisions of the federal government. You could also raise taxes, which would act to decrease big C, consumption, right? But remember that there is some of that decrease is going to decrease savings, and the remainder of it is going to decrease consumption. So you need to account for that. Now, another option, if you're looking for fiscal restraint, is to decrease public transfer payments. This is politically unpopular. It very rarely happens. You don't want to decrease someone's benefits, Social Security payments, for example, if they've worked their whole lives to earn those benefits for the purposes of restraining the economy. So this is rarely done, but it is an option. So if fiscal stimulus is the goal, the question is, do you increase government spending or do you decrease taxes? Well, it depends on whether you favor larger government or smaller government. And to apply stereotypes, Democrats typically favor larger government, Republicans favor smaller government. So it's fiscal stimulus, if that's what's called for, then a Democrat might favor increasing government spending, whereas a Republican might favor decreasing taxes. If fiscal restraint is called for, then a Democrat might favor raising taxes, whereas a Republican would favor decreasing government spending. And that is fiscal policy.